Leveraging derivatives in ALM for risk management. Introduction. Asset-Liability Management, ALM, is a critical technique in financial management. With the increasing complexity and volatility in the markets, derivatives have become pivotal in the strategic toolkit for risk management within ALM frameworks. Understanding derivatives in ALM. What are derivatives? Derivatives are financial instruments whose value is derived from the underlying assets, indexes, or interest rates. Common examples include futures, options, swaps, and forwards. These instruments are primarily used for hedging risks, speculating future prices, and arbitraging price differences between markets. Role in ALM. In ALM, derivatives serve as a hedge against various financial risks, such as interest rate fluctuations, currency exchange rate changes, and commodity price volatility. By effectively using derivatives, institutions can stabilize cash flows, manage refinancing risks, and optimize the asset-liability mismatch. Key strategies of using derivatives in ALM. Interest rate swaps. Interest rate swaps are contracts to exchange one stream of future interest payments for another, based on a specific principal amount. These are used by banks and financial institutions to manage the mismatch between the interest rates they pay on deposits and the rates they receive on loans. Case example. Imagine a bank that has lent a fixed-rate mortgage, but pays a variable rate on deposits. If interest rates rise, the bank could face a shortfall. By entering into an interest rate swap agreement, where it agrees to pay a fixed rate and receive a variable rate, the bank can offset the increase in payout on deposits, thus managing its interest rate exposure. Options. Options give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price within a specific period. Call options, buy, and put options, sell, can be utilized to protect against adverse price movements in both asset investments and liabilities. Strategy application. A corporate entity could purchase currency put options to protect against the depreciation of a foreign currency in which it has liabilities. This way, if the currency falls below the strike price, the entity can sell the currency at a favorable rate despite the market downturn, mitigating FX risk. Futures and forwards. Futures and forwards are contractual agreements to buy or sell a particular asset at a predetermined future date and price. These instruments can be used to lock in prices for commodities, securities, or currencies. Practical use. An airline company might use fuel futures to hedge against the risk of rising jet fuel prices. By locking in a price for the fuel it expects to consume in the future, the company can avoid unexpected spikes in fuel costs, ensuring more predictable operating expenses. Implementing a derivative strategy in ALM. Risk assessment. Before incorporating derivatives, it's crucial to conduct a comprehensive risk assessment. Identify the specific risks you're trying to hedge and the potential impact of these risks on your financial position. Strategy development. Develop a tailored strategy that aligns with your institution's risk tolerance, financial objectives, and regulatory requirements. This may involve a mix of derivatives to hedge against diverse types of risks. Continuous monitoring and adjustment. Derivative markets are dynamic. Regular monitoring of market conditions and the performance of your hedging strategies is essential. Adjustments should be made in response to changes in the risk profile or financial objectives of your institution. Conclusion. Leveraging derivatives in ALM can significantly enhance risk management capabilities. Through strategic use of interest rate swaps, options, and futures, institutions can protect against market volatilities and maintain financial stability. Want to learn more? Claire Trifle on LinkedIn.